Awesome. Great to see you, Scott. Thanks for having me.
Yeah, where is this opportunity? Because, these markets have been rocky to say the least.
Well, there's opportunity all over the place. So we're value investors. We like to look where the expectation gaps are the biggest between what we think is going to happen and what the market's implied expectations are. So there are a lot of things out there that are actually highly investable and we find very, very compelling. One of the groups we don't find as compelling are these tech names that trade at 20 to 40 times earnings with massive expectations for continued growth at a time where people are increasingly concerned about the economy. But if you look at what's been going on more broadly within the markets, the Fed has been taking capital out of the system. So capital is becoming more scarce, which means that things that rely on external financing, whether that's real estate, whether that's venture-backed deals, those things are not doing too well because capital has a cost. And so things are working normally again, unlike how they may have for the past decade. So there are a lot of opportunities actually out there. We like things that aren't invested heavily in these magnificent sevens. So
but the magnificent stock names, obviously none of which you own, trade at the valuations they do because of the perceived more dependable growth that they provide, while at the same time having balance sheets that look a lot better than a lot of those companies that value investors are perusing, wondering about where's the economy going to be, et cetera. How do you answer that?
Well, it comes down to the expectations for that growth moving forward and what sort of continued growth at a massive, massive scale you need to justify those valuations. So if Apple's a shrinking company trading at 28 times earnings, you want to own that? And they're buying back stock, overvalued stock? I don't want to own that. So there are actually things out there that we want to own, things that might make people throw up in their mouth, actually. So one name I really like right here is AT&T. Trades at the biggest discount on a price earnings basis relative to the market it ever has. A lot of people look at it and they hate it. They go, it's a multi-decade low. But guess what? It's got a 16% free cash flow yield, half of which is coming back to you as the investor, and the other half of which is going to pay down debt. So they're doing very value accretive things with a huge free cash flow yield and a low valuation. And there's a lot of things out there like that we want to buy.
I know you like Stellantis, and so you obviously must have an opinion on how the UAW strike is going to turn out, how it's going to end, and when it might, because right now the two sides seem as far apart as they've been since the very beginning of this whole affair. So how do you think about that as it relates to the performance of these stocks?
Yeah, my only opinion on when that may end is that it will end eventually because the workers need money and the car companies need workers. And so there's a good exchange there to be had. The way I look at it is Stellantis trades at 1.5 times trailing EBIT, which, that's a very low valuation. It effectively is assuming that profits are going to collapse in the near future. They might, or they might keep printing money. Who knows? Either way, it's kicking off a ton of excess free cash flow, buying back stock. Its entire debt stack is covered by cash on the balance sheet. It's yielding 8%. So yeah, I understand there's a strike going on. That will eventually get worked out. And the expectations here are so low that you're getting paid to wait, and why not?
And you feel like that's the better play than either General Motors or Ford?
I think in a lot of these cases, the entire sectors have gotten smacked around. I like Stellantis personally because the management team there is heavily aligned. And Carlos Tavares is doing a great job. He's got a great track record executing against the goals. And so we like that one. You could ask about Verizon versus AT&T. We think AT&T is marginally cheaper, but they're both good bets in this environment, we think.
Yeah. How do you view what's been happening in the bond market with rates going up and the pressure that's been putting on stocks? And when that reaches a real significant breaking point, yes, stocks have been upset a bit by it, but we haven't seen, any massive pullback in equities by any degree.
Some of the proprietary measures we look at regarding liquidity are starting to dry up pretty significantly in the past couple of weeks. So it is starting to reach a breaking point. We certainly hope we see some sort of tone shift in the next Fed meeting to either a dovish hold or potentially even a cut. The rates are well above where inflation readings are coming in now. So the system works. They are taking air out of the balloon here, but the system is working, Scott. So agree rates are slowing things down. Bonds are investable again. They weren't for a while. The volatility has knocked them down a lot, and they are investable again. So I think, having an actual cost of capital out there in the world is a good thing.